If there's one truth when it comes to investing, is that no one knows, no one knows whether something will go up, down, or even sideways. Hence, take solace that when you do get it wrong every now and then, it's okay. Hence, you might as well get it off your chest. Take the Australian property market back in 2020 when COVID first came to light. Experts from seasoned economists at your big four banks to your strategists at your large institutional research houses, they all got it wrong. With the exception of a guy named Christopher Joy from Coolaway Capital. Google him and check out his articles on Australia's Financial Review. Really knows his stuff. 10, 15, 20% down in property prices, when in actual fact, combined prices across Australia's major cities and regional areas were actually up 2%. Of course, the Australian market and many others around the world have skyrocketed this year due to a combination of low interest rates, returning expats, FOMO, and a host of other factors. So, how does one approach investing when there are so many unknowns? I like to use 5 harmless guidelines to help me utilize the tricks when it comes to investing long term. You can research, you can infer from existing data, or you can speak to every single employee. But at the end of the day, no one knows what the future will be like. But hopefully, with these 5 timeless guidelines, you can at least get close. Number 1, diversify. By all means, you could plow all your money into the next afterpay, hoping to 100 times your money. But that's just a bit too risky. So instead, how about you spread out your capital? We could look at shares, but within shares, you've got small caps, healthcare stocks, banking institutions, passive index funds like ETF that invest in a particular subset of companies, or themes such as climate change. We can look at property, and within it, there's residential, commercial, property for Airbnb purposes and REITs, real estate investment trusts that are traded on the exchange. We can buy Pokemon cards, catastrophe funds, or even a low-kilometer 1999 Honda S2000. You essentially want a portfolio that has various assets that aren't correlated with one another. Put simply, if one goes down, the other goes up, which therefore minimizes your losses. Number 2, look for high quality. Is the company you're backing run by a seasoned executive with investors who have done it before, where there's a strong competitive moat around their business model? Think something unique and endearing that can generate substantial future cash flows. Think Google, who essentially owns all the web traffic in the Western world, and Apple, creating their ubiquitous devices because they've so successfully combined hardware and software as one. Is it the ugliest house on the most expensive street, so hence just need some TLC? Or is it a real estate investment trust that just specializes in logistics and warehouse assets, tenanted by the most successful dual-play online retailers? Number 3, purchasing below market value. Value can be very subjective, of course, because it's based on so many inputs and variables. Inferred assumptions will ultimately be made if you're looking at it from a discounted cash flow point of view. So, can you get it below value? How much is it really worth based on its fundamentals and comparable instruments? As the data goes, profit is made when you buy. Number 4, think long term. Expand your horizon and avoid short term noise. Easier said than done? Definitely. So it really comes down to your investment thesis, which will of course evolve as new information is taken in. As the father of value investing, Benjamin Graham, once said, in the short term, the market is purely a popularity contest, tallying up those companies which are most popular and those that aren't. But in the long run, the market, corrects itself, where it turns more into a weighing machine, assessing the substance of every company. Now, when you think long term, the power of compounding comes into play. Number 5, lastly, you need to show conviction. The decisions you make today regarding purchasing X, Y, or Z need to be backed by strong reasoning, because if it isn't, you're simply going to flounder when there's too much noise in the market. Why did you buy it? What's your investment thesis? By all means, you could get lucky, but when it comes to successful long-term investing, it takes a lot of discipline and innate luck. So like I said, guys, no one knows whether something will go up, down, or sideways. But hopefully, with these 5 timeless guidelines of 1, diversifying, 2, looking for quality, 3, purchasing below market value, 4, thinking long term, and 5, showing conviction, it will give you the confidence that you can succeed. And if you get it wrong, in which I'm sure everyone has, no one has a perfect record, pick yourself up and play again, because the investing game never ends.